I started a mortgage company. I started Better.com because I went through the mortgage process with my wife and myself, and we were successful finance professionals. And we were like, this is so complicated. Like, how do I get pre-approved? We created a online way where you come online, everything is transparent, everything is easy, and just make it understandable for life's most important financial transaction.
All right, guys, welcome to Financial Freestyle here on Yahoo Finance. I'm your boy, Ross Mack. Now, look, guys, whether you're a professional on Wall Street, a retail investor, or someone that's looking to improve their overall financial situation, there's always a first step you got to take. And guys, look no further, because I'm speaking to some of the most influential people in finance and learning about their pathway to economic prosperity. And today's no different. I'm sitting down with the Vishal Garg, CEO of mortgage lending company, Better.com.
So nice to be here. Thank you for having me.
Dude, so amazing to have you, right? I always start off saying, like, who's Vishal? But I just want to say thank you because for starters, my wife and I use Better.com to buy our home.
That makes me feel happy to hear. Like, you know, making homeownership more affordable, more accessible to all Americans. That's like that's my life's mission. And so happy to hear when I am able to talk to a customer.
And so, for our audience, right, like, what is Better.com?
Better.com is a platform where you can go online and easily get a mortgage, get pre-approved or refinance a home in as little as 3 minutes, lock your rate in 15 minutes, and now with our one-day mortgage process, get fully underwritten, committed within a day, and save a ton of money. The average American family saves like $8,200 financing with Better versus like a traditional mortgage broker. And on top of that, we now offer title insurance, homeowners insurance, life insurance, all these other products that make your life easier as you're going through the mortgage process.
That's amazing, right? I think when you think about the overall ecosystem of just finance as a whole, right, the average person is scared, right? It's such a scary process, right? Oh, I don't know how to get out of debt. I don't know what I should be doing for retirement. I don't know how to finance a car. But it only gets amplified when you're trying to buy a home. So, like, talk to me about, like, one, right, how you're democratizing that, and, like, how your process is even better for the average person.
Totally. Like, well, it almost starts with like how I got into this, right? Mm-hmm. So I started a mortgage company. I started Better.com because I went through the mortgage process with my wife and myself, and we were successful finance professionals. And we were like, this is so complicated. Like, how do I get pre-approved? Who are all these people calling me, asking me for my social security number? Right. You know, why should I do this? Like, why do I have to walk into a branch? Why do I have to fax you stuff? It was like 2013, 2014. What am I doing here? Why isn't there an easy online way to do this like there's for everything else? And what I discovered is that the mortgage process basically looks like the internet was not invented. So we created a online way where you come online, everything is transparent, everything is easy, you understand everything that's happening, all the processes, the fees, what you're going to have to pay, what you're going to have to do next, and just make it understandable for life's most important financial transaction. Like 68% of Americans' wealth is in their homes, and mortgage finance is the largest category of consumer finance, like $15 trillion, and yet most Americans know nothing about it. And we said, we're going to shine a light on this, we're going to make it easier, and we're going to make it better. And that's what we've done in the past 9 years we've been around.
That's amazing, man. Shout out my boy, JP Grant, because when I was going through the process, he's like, oh, dude, I'm working at Better.com, bro. Let me, he just sent me the info, and I did a little research. And from there, my wife and I, at that time, I think we had just one child. Now we got 3, but the process was smooth. I think we were approved, pre-approved or whatever within like 3 days. It was we just uploaded our documents, and it was very easy. And so let's actually talk about your journey, right? Who you are and how did you get to starting a company like Better?
Well, I was born in India. I came here when I was 7, grew up in Queens, middle-class family, went to high school in downtown Manhattan called Stuyvesant High School, which gave me a lot of opportunities, got me out of my Queens mindset. Mm-hmm. And then from there, went on and decided I was going to work in finance. I worked full-time while I went to college, supported myself, and then got a job at like my dream job in investment banking at Morgan Stanley doing mergers and acquisitions. And it was 1998. And, I was like, okay, I'm going to work in finance. I'm going to go work for a private equity fund or a hedge fund, and I'm going to have this career. And then I went on a pitch with someone who would later become one of my investors, Mary Meeker, who back then was like the queen of the internet. And so we went to pitch this internet company. And I'm sitting across the table, and everybody had always told me, hey, Vishal, you should like go start a company like once you've had like 10, 20 years of experience. And here are these other guys, they were like 24 years old, and we were pitching them an IPO. And I was like, I'm on the wrong side of the table. The world has changed. Like, I'm going to go start an internet company. So I dropped out of the analyst program at Morgan Stanley, said, I'm going to go start an internet company. They're like, what are you going to do? And I was like, I don't know, but I'm going to figure it out. And so I asked a bunch of my mentors, like what I should do. And one of them said, well, you should start a company based on something you've had a problem with in the past, right? Something you've experienced difficulty in, because then you'll have empathy for the consumer experience and you'll be able to make it better. And so, my friends and I, we all had trouble like paying for college and figuring out how to make ends meet. And so so I started a company called myrichuncle.com. So everybody should have a rich uncle to help them pay for college. And it was the first online student loan company. My Rich Uncle was really successful. I took it public when I was 26 years old. Wow. And we built it into one of the top 5 student loan companies in America.
That's remarkable. The thing that I find most remarkable is you just quit Morgan Stanley without a for sure path to where you're going. You was like, yeah, I quit. I just know that I'm in the midst of this internet.com, this whole era.
I said to my dad, I'm going to go and quit. And he's like, are you sure? And I said, yeah, I always want to run my own company. And so he's like, well, if you want to run your own company, then you should do today rather than do tomorrow. So he's like, okay, do that. He said, just promise me one thing, you go take the GMAT. So if it doesn't work out, you'll, apply to business school. And I was like, okay, yeah, like I have a way out. Like, and I've always thought of it that way. It's like, what's my worst case scenario? My worst case scenario, I'm going to go to business school, get back into it, figure it out. Some other investment banker will hire me and I'll figure it out. So I think I was like, my education and my drive, like kind of helped me kind of like look at the downside scenario. And I think it's one of the things that's helped us become successful, even at Better. When we first got started at Better, we didn't actually start from scratch. We took over an existing mortgage company, which had all the licenses and had the approvals to go and sell directly to Fannie Mae and Freddie Mac. So we knew we could offer the lowest price to the consumer. But even in there, I got like Goldman Sachs to invest, I got Kleiner Perkins to invest, I got some of the best investors in the world to invest. It was all about, well, in the worst case scenario, we have a tech-enabled mortgage company. In the best case scenario, we have a global homeownership company. And so always being able to say what's my worst case scenario, what's one of my best case scenario, and being able to be transparent and honest with myself, that's been one of the things that's really helped me be a good entrepreneur.
I love it. And so one of the stats you said was that 68% of America's net worth is within their home.
Yes.
And there's another stat that says 90% of the world's millionaires get their start through real estate. So tell me your view, why are you passionate about helping people become homeowners?
I think home ownership is one of those things where it's not just an asset that you own, but it's also an asset that you enjoy, right? So studies have shown that children who grow up where their parents own their home feel more secure and have better interpersonal relationships and do better in school than people who are renting. And that makes sense. If you imagine you making friends and now you have to move because the landlord raised the rent, people who own their home, their housing payment is fixed. And in America for 30 years. So every month, exactly how much you have to pay for housing. You don't have to worry about the rent going up. You don't have to worry about other incidental expenses. So that allows you to save. So your home becomes a vessel for savings and it enables long-term financial planning. And over time, as the value of your home goes up, you've got a fixed rate mortgage. You're paying exactly the same monthly payment, but your home is going up. So now you're accreting savings and building home equity. Americans today are sitting on over $30 trillion of home equity that they've built up. And that's an incredible amount of cushion that they can then use. They can use it to start a business. They can use it to send their kids to college. You can do all of these things that are long-term investments in your future because you invested in your home.
I love it. So let's actually talk to the audience, right? For anyone watching that is potential homeowners, right? Obviously, given the current climate, economic climate, what are some trends that potential homeowners should be aware of?
I think, look, the biggest trend is that interest rates are at, 30-year highs. But usually when interest rates are high, home prices are a little lower. And people who wait for interest rates to go down they're rushing into a market where home prices are going up. Like that's what happened in 2020 and 2021. Interest rates went down, but home prices went up. And so what you'd rather do if you've got the savings to do it is buy a home when interest rates are high and then refinance that home when interest rates are low. So, yes, today the interest rate's like 6.5%, but if you can lock the home you want to live in for the next 5, 10, 15, 20 years at that price, over the next couple of years, interest rates probably going to go back down to 3%. That's what all the economists say. Even the Fed says that in the next couple of years, that's going to happen. So you immediately know that like my monthly housing payment is going to get cut in half, but I'm going to keep all the appreciation. So that's a really good trade for anybody to get into. Now, the thing that people have trouble with is how am I going to come together with the down payment? Everyone thinks that you need 20% down to afford a home. The truth is, Fannie Mae for first-time home buyers allows you to buy a home with 3% down. So on a $300,000 house, that's $10,000. Don't own your car, lease your cars. And, you've got $10,000. Buy a home. Create this vessel for savings and get started. That's what I encourage people to do.
I love that. Let's actually go into some more misconceptions when it comes to home ownership, because like we said, like when it comes to money, right, everybody gets anxiety. And especially, right, your biggest purchase of your lifetime generally will be your home. And so, right, I think I love that you dispelled that myth that you don't need 20% to put down. Are there any other myths that, our viewers could actually take home and,
Totally. I think in over 25 different states, there are down payment assistance programs where if you are low or moderate income, you can qualify for a state grant that is forgivable over time. If you're a teacher, a fireman, a policeman, or work in, any number of first responder professions or, important social state professions, you can get grants that enable you to get on the homeownership ladder with almost 0% down, right? And so I think that's like one of the big misconceptions. So down payment assistance programs, huge. Really look into them. Like work with a lender that will automatically qualify or tell you about which ones you can qualify for. I think that's another big misconception. The second thing is that interest rates are high. Interest rates are not high. You just need to shop around. Look around on the internet. Don't just go with the first mortgage broker or first mortgage salesman you get in touch with, right? Look at points fees. If you plan to stay in the house for a long time, maybe pay a few points and get a lower interest rate. If you plan to upgrade quickly, just get the rate that you're going to get, pay as little fees as possible, and keep moving forward. There's so many things that, we make better by making the whole process transparent. So, we've got a ton of tools on better.com. Check that out.
I love it. Especially those, homeowners assistance programs. Shout out one of my buddies in Chicago, Dre. He was telling me about NACA. And so, right, at the end of the day, there are a lot of resources that people should definitely take advantage of. But guys, don't go anywhere. We got to take a quick break. When we come back, we'll be having more from the Vishal Garg. All right, guys, welcome back to Financial Freestyle, and we're here with the Vishal Garg, CEO of mortgage lending company Better.com, and he's giving us a lot of game, right, especially when it comes to this overall real estate industry. And I think you guys are just obviously doing so much when it comes to the overall industry, right? Like, tell me about One Day Mortgage, right? You guys are just doing all type of stuff.
Yeah, right, so One Day Mortgage is a product that I had been working on and rolling out for almost 7 years before I launched it in 2023. And it comes from my own personal experience. We lost the home that we were going to buy to an all-cash bid because I wasn't willing to waive financing contingencies because I was like, I don't know if I'm going to get approved for a mortgage or not. And the mortgage company that we were going with said it was going to take 57 days to close a mortgage. Wow. And so what we did was this should be 1 day. How can we get it down to 1 day? So we use machine learning, we use AI, we automated chunks of the process. So now when you go, a consumer can come on their website and say, hey, I've got a purchase contract to buy a house. And that same day, they upload their purchase contract, they give us a little bit of income data, a bit of tax data, and they fill out some more things. And that very day, within 8 hours on average, we will return back a mortgage commitment letter, something that would take a typical mortgage company 45 days to do. We will do it within 8 hours and give it to the consumer. And in doing so, we remove the stigma that a consumer who's got a mortgage has with a real estate broker versus a cash buyer. So we make all of America cash buyers with our One Day Mortgage program.
Wait, how are you able to do that, right? If whether it's just old, whether this is literally the blockbuster model versus, the Netflix, but like, why are you able to do it in 8 hours, or less than 24 hours versus 45 days?
So I think the key is the technology that we built. We built this platform called Tin Man, and Tin Man is a rules engine powered by machine learning, where we're capturing consumer data about you from all these third-party sources, and we're only asking you for the absolute minimum amount that we need from you to actually fulfill the loan. That compares to other mortgage companies where they're literally taking an application, they're asking you all these questions, they're not relevant to you. You're wondering, why are you asking me this? Or why are you asking me this second time, third time? Because they're not connected. Their systems are all broken. Like there's like a software for taking the application, there's a software for underwriting the loan, a software for like analyzing tax returns. So they're like going through 8 different broken systems. We've built Tin Man all in one to make the mortgage process easier. And that enables us to do one-day mortgage.
That's remarkable. My eyebrows are up. One-day mortgages. And I know you said one of the things is like, even when rates are higher, you buy, right? The idea is you refinance later on. But like to the average American where, we're seeing housing prices, double and 3x over, call it, the past 5 years. However, their income hasn't nearly grown at that rate, right? Mm-hmm. What do you think when the average person is saying, the typical American dream is getting less and less in reach, so to speak?
I think it's totally fair. Home prices are high. In a lot of places, it makes more sense to rent than it does to buy a home. But I think when you look at that math, you're only looking at your current monthly payment. What you're forgetting is that a chunk of the monthly payment on a mortgage is actually paying principal down, right? So it's not apples to apples. If you're paying $1,500 a month on your mortgage and you're paying $1,500 a month in rent, there's a chunk of that that's going to principal payment on your mortgage, right, that you're accreting wealth in. So I think that that's an important consideration. I think the other thing is that when you're paying rent, you're paying your landlord's mortgage. I always like to say, right? He's the one getting the appreciation on that home. So I think there's very few assets that over the long term have performed, that are easily available and understandable by the average American family, that have performed as well as buying and owning your own home. And so just like, financial advisors advise you, don't buy stocks when stocks are going up, or buy stocks consistently over time. It's the same thing. I think, you want to be participating in real estate wealth accretion every year in one way, shape, or form. And the best way to do that is to actually do it in a way where you can also enjoy yourself. You can tell your kids, hey, this is your house. Hey, this is your room. You can do what you want with this. You're going to have this for a long time. Those things are really important. So there's all these other non-economic benefits from homeownership as well, that if you add it all together, really makes sense. And I think the American dream has gotten a little bit tougher to get into, but it's still the American dream.
And so, right, do you have a quick stat rule, right? Obviously, there are models where it's buy versus rent, right? To the audience, is there a point when because once again, right, this is the thing that most people get the most anxiety about. But is there kind of a steadfast rule that you could give where it say, if you're able to afford this in rent, you could actually purchase a home?
I think if you're able to afford more than $1,500 a month in rent, you should buy your own home. I think you should find a comparable place to where the one you're renting, get into it, and then over time build equity. You can then use it, you can upgrade from there. You can use it in an investment property. When rates come down, you can refinance it and rent it out to somebody else. Those are things that you can do with the real estate, so you don't have to feel locked in the same way, right? If you treat it yes, it's my home, but it's also an asset. And I think that's where people sort of have trouble kind of separating the two. And, but if you do that, you have a lot of flexibility and a lot of optionality that I know regular folks have a hard time understanding the value of optionality, but there's a ton of optionality because you get to keep all the upside. The interest rate stays the same.
I love it. Let's talk about, what you view when it comes to the future of real estate, because now we're seeing, the largest asset manager, BlackRock, being one of the largest single family home owners in America. And so what's your view on that? And, how should the typical investor or person looking to purchase a home not actually get discouraged?
Yeah. So I think, it's interesting that as Americans are thinking about not becoming homeowners, these very savvy institutional investors are becoming homeowners, right? So you should be going where the smart money is going. You should become a homeowner, right? And I think the goal with Better is, what does that institutional investor have that the average homeowner doesn't have? One, they have information, right? And so I think, being able to surface that information, places like, if you come to our site, better.com, you get all the tips and tools. You can understand all the different things that a typical institutional investor would be able to understand, and make those decisions smartly. And I think, again, I think when you see the big institutional investors go in a particular direction, that's where you should be going too.
I love it, right? You're given, I wish we had, more time, right? I think the information you're given is, $1 million worth of game or $1 billion worth of game. And so what's your view on REITs?
I think REITs are a really good way to get into the first step of understanding homeownership. I would look at REITs, I would look at some of these institutional landlords that are publicly traded. I'd look at some of these apartment REITs where they basically own large numbers of apartments and they rent them out. The one thing I would caution is REITs are highly levered, right, at times. So I'd look for one with low leverage unless you have a high risk appetite. And the returns can be quite good.
I love it. And to the people at home, right, a REIT is a real estate investment trust. It's literally a portfolio of real estate properties. And by law, they have to pay out 80 to 90% of the profits to all the shareholders. So something to definitely consider. Last question, right? What advice, if you could go back and talk to your 18-year-old self, what would you tell yourself?
I would say, don't be in such a hurry. So I was in such a hurry when I was a young person to get older, to be able to do things, to make my mark in the world. And I feel like, now I look at my kids and I say, wow. And I've got 3 beautiful kids. And, I tell them, slow it down. Enjoy the moment. You're not going to be young forever, right? Life is going to come. Responsibilities are going to come. All these things are going to come. And I think you can savor each stage of life one at a time. Unfortunately, I grew up in Queens, not a lot of money. I was in a hurry to not be poor. And, I think I gave up a lot in the process.
I think that you wouldn't be where you were if you were patient, right? There's a old saying, patience is a virtue, and I've always said impatience is a virtue. Because if you just sit and wait, sometimes you gotta have that sense of urgency.
Yeah.
So, man, it's been an honor.
Awesome. Thank you so much for having me.
Appreciate you. That's it for this episode of Financial Freestyle. I truly want to thank you, Vishal, for coming and joining us.
Thank you for having me.
So you guys at home, man, I really hope you're able to gather something from this, gain something, man, and especially when you're on your own financial journey. Be sure to join us next week for a brand new episode here on Yahoo Finance.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.